Let's go. It's about that time, everyone. I hope you guys are ready because I'm ready. It's going to be a fiery one. So much so, I'm so pissed off. We're going to forego some of the usual cheeky shenanigans, get into the show. Yeah, we'll check the market. Yeah, we'll get into our proprietary models. But first, we're going to talk some shit. Because you know what? I'm tired of the rhetoric. I'm tired of the nonsense. There's a lot of stuff going on that I'm going to call out today. And if you guys have feelings and they're prone to being hurt, spoiler alert, this show is not for you because they're probably going to get hurt. Okay, let's just start right there out the gate. Number one. Number two, this show is proudly brought to you by the team over at Fridays. Go to joinfridays.com, enter code HIGHER. We'll get some love. You'll get some love. I currently use a lot of their products, not the least of which is I microdose tirzepatide and I take NAD+. Again, joinfridays.com. Use code HIGHER. We'll get some love. You'll get some love. And everybody will feel, hopefully, a little bit better. And the goal here is longevity, kids. Not to be confused with longevity of shenanigans in the market, which has been long. Let's start the day with what I like to call a little bit of a pace setter, okay? What we're going to do here is we're going to look at an old school video of one of my favorite economists of all time, Milton Friedman. And Milton is going to break us down with what we're going to use as a baseline for a lot of the trash talking we're going to do today, okay? So for those of you sitting in your locked and upright positions, your tray tables and seat backs are ready to go, this one is for all of us to start our day with.
Inflation is made in Washington because only Washington can create money. And any other attribution to other groups of inflation is wrong. Consumers don't produce it. Producers don't produce it. The trade unions don't produce it. Foreign sheiks don't produce it. Oil imports don't produce it. What produces it is too much government spending and too much government creation of money and nothing else.
Mm-hmm. That's right, kids. The whole concept, the preconceived notion that inflation is caused solely by consumer spending may be misdirected. Sure, it has impacts to it, but are we confusing impacts with the majority of the cause of what really drives inflation? We're in a market now where inflation seems to be in line. we're in a market now where jobs seem to be stabilizing. So then I ask the proverbial question, what does cause inflation? Is it government spending? Because if so, the government is spending more money now than ever before. This should come as no surprise to anybody who watches the show or listens to any of our feeds. So I asked the question because it's important, because some bullshit went down today that we have to talk about, okay? And I don't want to be the guy, but you guys know that I am that guy. So let's talk about some of that bullshit. We are going to look first at some of the conversation that's happening over at CNBC on the social platform. And I know I'm deviating a little bit from the show's traditional path forward here to bring you guys this stuff, but I think that this is a good way to start the show, because honestly, everything else is secondary to this nonsensical social narrative that we're seeing out here. So let's get into it. This from CNBC, the term, I'm not even going to go into it, to the words boom and recession, it highlights how the average American doesn't feel like they're reaping the benefits of an economy that is, quote, on paper, humming along, according to the creator Matt Stoller. Yeah, I think most people feel that way. I think most people are going, what the actual hell, bro? Everybody's talking about the economy booming. Companies are making more money than ever. The dividends aren't being paid out. There's all this capital X reinvestment. Where's my chunk of the American dream? Where's my pie? I can't buy a home. Yeah, the stock market's booming. I got some money in the markets, but I don't feel that way. And I don't think a lot of Americans feel that way. So therein lies the problem. Economic output in the stock market are surging. We've all seen it. Dow hit 50,000. We've all heard that quote, right? Consumers are spending big, and the post-pandemic recession that many expected never materialized. But many feel terrible about their finances, with debt at all-time highs. You guys have seen my post in both Reels and in other short-form video format, and obviously the other tertiary stuff that I've been posting on X and Threads, for example. I've proven this concept out. There are some serious problems with the debt load right now for all Americans. And yes, you could point to home equity lines of credit of being an easy place for people to tap excess equity in their homes. But are we really setting ourselves up for failure here? The question remains, but I think we are. Carrying on. Okay, well, if debt's at an all-time high, the majority of Americans feel incorrectly believe the country is in economic slowdown. Where is the disconnect? There is a fundamental problem here. Economic output and stock market are surging is the key words we're going to look at here. This quote here will come back to highlight that many Americans feel terrible about their finances with debt at all-time highs. And I've proven that out. That is not a debatable point. Okay, now we're set up. Milton Friedman, number one, says that inflation is caused by government spending. Number two, we know that Americans are not feeling pretty good about things because inflation is hurting them materially, so much so that this is now a CNBC post. You've seen my comments on debt and defaults in the credit card space. So are you ready for the meat and potatoes? We're going to talk a little bit about tariffs today, because guess what? Some type of crazy ass shit went down today that everybody decided they're going to just go, oh, that's interesting. And I wonder if I think I did save it in my photos here. Maybe I'll just pull it over that way, give you guys a better, cleaner feed of what this looks like. No, I didn't. So we'll go to X. So 1 second, I apologize. So on X, I posted a 2-minute video, which we are all going to watch collaboratively, because I think it's important to go through and look at a little bit of what's going on in mainstream media and some of the narrative that's happening there. So I'm pulling this up now. And yeah, here we go, kids. Let's get into the screen share view. I'm going to make this full screen so we can do that. I'll back this bad boy up a little bit. And let's see here. Let's pause it because I want you guys to hear the whole thing.
A study by the New York Federal Reserve claims 90% of the tariff burden is being shouldered by U.S. firms and consumers, but the White House disagrees. Joining us now, White House National Economic Council Director Kevin Hassett. This will be, Kevin, good to see you. This will be a continuation of a discussion we had yesterday with Ambassador, with our trade representative, Jameson Greer, and we talked about whether something's regressive, but we'll try to get into all of this. And we saw an inflation number last week, 2.4%. If it is being shouldered by U.S. firms and consumers, U.S. firms are eating some of it, or consumers it's being offset by something else, whether it's lower gas prices.
So we're starting off good here. We're starting off very simple. He's asking the question. It seems that consumers are bearing this. It's being offset. Inflation looks weird. What's going on? Now listen to the level of stupidity that comes out of this guy.
Just in the numbers themselves, that doesn't hold water.
Yes.
right?
Yeah, I mean, the paper is an embarrassment. It's, I think, the worst paper I've ever seen in the history of the Federal Reserve System. The people associated with this paper should presumably be disciplined because what they've done is they've put out a conclusion which has created a lot of news that's highly partisan based on analysis that wouldn't be accepted.
And bullshit, we're going to prove it. It's not highly partisan. It's not a weird-ass analysis. You're lying. That's what's happening here. That's what a liar looks like. Everybody in America is watching this going, hey, Chris, what does a liar look like? It looks like this.
In a first semester econ class, the bottom line is that if you're wondering, like, who bears the burden of something, of a tariff, then you remember, Joe, you got supply curves, demand curves.
No, fundamentally, absolutely not. This is why realtors have such a problem. Is they're all like, oh my God, demand curve, supply curve, it's all economic 101. Why? Because your association tells you that shit? Because the National Association of Realtors and the Mortgage Banker Association all tell you that the way to deal with this situation is supply and demand, and if you get rates down, it's a solution to the affordability crisis. What's happening is America is having their lack of financial literacy weaponized against them, and then they gaslight you into going, oh yeah, that's simple, I know that. They go, well, this is a basic economics 101 thing, man. You should know this. No, he's fucking wrong. That's what's going on here, and he's saying that hoping that everybody goes, oh yeah, I remember basic economics 101. No, you don't, because if you did, then he's full of shit.
Shift them around, you got consumer surplus, you got producer surplus, and then you look and see how it all works out in the end. And they're basically only looking at changes in prices. So they're assuming that quantities don't move at all. But guess what? Quantities did move at all. So the basic theory of President Trump's tariffs is that we're importing stuff from China, but we got producers in the U.S. that make the same stuff, maybe at a slightly higher price. Bring the stuff home.
Maybe at a slightly higher price. That's called inflation, jackass. That's what that is. He's saying that consumers bear the cost, and you're saying at a slightly higher price. Why is that slightly higher price being passed to Americans? Because they're paying tariffs, and it's being distributed evenly amongst the American population who are buying the products that you're putting tariffs on.
Create the demand at home, then that will hurt China and drive up wages in the U.S., and American consumers will be better off. So what have we seen? Prices have gone down. Inflation is...
What? Prices have not gone down. No, not at all. As a matter of fact, what the fuck?
Down over time. Import prices dropped a lot in the first half of the year and then leveled off, and real wages were up $1,400 on average last year.
We'll talk about real wages later, kids. That is also misrepresentation a little bit.
Which means that consumers were made better off by the tariffs. And so consumers couldn't have been made better off by the tariffs.
He literally laughed. Did you catch that? He literally laughed as he was saying it.
If this New York Fed analysis was correct, it's really just an embarrassment. But I can't imagine who signed off on it, frankly.
But in the best case...
It's an embarrassment? I can't imagine who signed off on it? I mean, damn, bro. Talk about an indictment. You are going after an organization, but it's absolutely fucking nuts. But so you know what? I'm gonna do this. Okay, on the show we have talked about it. You probably saw this on a previous episode. We talked about the Kiel Institute's analysis of this exact same thing. And if you know who these institutes are, trust me, these are the big boys. These are the players. Everybody I'm gonna talk to you about right now, you're gonna go, oh shit, that sounds pretty serious, because it is. Okay, it's because it's real and it's material and it is. It's a big deal. So just to be clear here. You guys have heard of the Kiel Institute on the show. We talked about it before. Kiel Institute, January 2026, foreign exporters absorb about 4%. 4%, implying that 96% pass through to the U.S. buyers at the shipment level data that they're looking at. So the Kiel Institute has come out. We analyzed it in full detail on the show that 96% of the tariffs get passed on to the consumers, and you're criticizing this outlet for saying that consumers bear the burden and you're calling them full of shit? Okay, maybe that's 1v1. Maybe there's some other opinions out there. Oh, I don't know. How about an organization like the CBO? CBO, February 2026. This month, foreign exporters absorb about 5%, 95% borne domestically, PCE price index plus about 8 percentage points by end of 2026. Negligible additional effects afterwards. So yeah, we bear over 90%. Matter of fact, they're saying 95% is borne by the consumer. Okay, now it's 2v1. Maybe there's another reputable outlet out there, Chris, who says that, hey, you know what? I kind of agree with the article, and I think this dude is kind of wrong. Well, the National Bureau of Economic Research, NBER, of all people, who haven't said a goddamn word about recessions for literally over a year, they came out recently in January and February with their February 2026 revision of a January paper. So literally this month, tariff pass-through to the U.S. import prices is almost 100%. This is the firm, the National Bureau of Economic Research, whose sole responsibility it is, and the ones we look at, if we ever have an official declared recession, it's because they said so. Okay? Mohammed El-Rain is on their board. I mean, these are sensationally intelligent people, and you're going to criticize a paper for saying the exact same thing that all three of these, frankly, institutions, bedrock institutions, are saying is actually true. This is not politics, okay? This is just math. Why does everything need to be politicized? Why can't we just say? And I understand there's going to be people who are going to watch this and go, Chris, this is political, okay? No, it's not. This is math. Can tariffs long-term bring business back to the United States and manufacturing? Yes, they can. 100%. Can this long-term have the benefits that you do read about in Economics 101? Yes, it can. But in order for that to happen, number one, you need time, i.e. long-term. And number two, you need consistency of tariffs. What we keep doing is putting tariffs on, negotiating, taking tariffs off. So what we're in effect doing is taxing the U.S. consumer. And the part where this just gets absolutely mind-blowing wild is all this additional revenue that we're bringing on that we're then in turn saying, hey, we're going to give the consumer a tax break because we made so much money. No, they got an interest-free loan from you, from me, from everybody else that they're going to give back to us in the form of another stimulus check, which is going to just stimulate more inflation in the economy. So these numbers, which we're already concerning about jobs, which we already know are kind of questionable at best, now we got this. Like, what are we doing? What are we doing? It's at a point where it's insanity, and everyone's going like, let me use this to provoke political divide and sensationalism, and we'll do some virtue signaling around it. And it's like, no, bro, this is just math. You can't buy into the rhetoric. And this is why I see stuff like CNBC, and I see talking heads, and I see people that are supposed to be officials, and I say, you know what? You got to discount this stuff. You got to listen to independent media, which I happen to be part of. Let's check the comments. Shout out to you guys on Instagram for all the comments here. Ha ha ha. Wish I could I could lie like this. Yeah, right. It's complete and total bold-faced lie. Even caught himself laughing halfway through. I can promise you this: the price hikes that are passed on to consumers, 1,000%. I can promise you this: they already are. All three institutes have already said that. My company did it. Yeah, I don't doubt that whatsoever. Well, Chris, companies are so benevolent in this system that they're eating up the tariffs so consumers won't. Yo, Rosie, a rosy, optimistic view. You see what I did there? Yeah. That's certainly not the case. And it's absolutely wild to see anybody suggest that that is in any way, shape, or form going to be the ideology of how corporate American capitalism works. It just doesn't work that way. Who in their right mind thought, hey, you know what? We're going to make less money here because these tariffs, these costs are coming along. So let's just eat these so our prices stay the same, because supply and demand and economics 101, man. No, you know what they do? They're going to limit the supply or change things to increase their pricing. And this is where people always quote supply and demand. They love to quote the economics 101 argument of supply and demand. Here's the fundamental problem with that, okay? The fundamental problem with quoting supply and demand as your narrative backbone for everything, like you learn in an economics 101 class, is that that's a static conversation. Is in economics 101, you don't have a Molotov cocktail of variables going up and down. You're looking at the impact of one variable on another variable, and that's all you look at. When in reality, supply is a function of cost as well. There are other components to this, right? And cost is not just unique to price. It's what is your actual pain point, your friction points to buy something. Another great example of this is the mortgage market, okay? And we're going to get into this here too. Mortgage market, lends, loans. Every single time I touch this topic, somebody politicizes the living hell out of it. And it drives me absolutely nuts, because here's the problem, okay? If you guys want to politicize whether we need more or less of supply and bring politics into it and virtue signal and have all these things in your bios, what you're doing is you're devaluing the basic precepts. If something makes sense fundamentally from a mathematics perspective, from a science-based perspective, then all this other noise you're adding to it because you have altruistic agendas takes away from the credibility. Your agenda should not be done, should not change whether this is empirically true or not. And here is the sad part. Credit situations have tightened across the country post-Great Financial Crisis, and as a result of this, Dodd-Frank caused more friction in the credit system. You can't get money as easily as you once did, and not having access to money as easily as you once did means there's more friction and price becomes more of a pain point. Not because the expensiveness and your ability to buy it changed because of the value of it, because the friction point to get to that value changed. There are no more true stated income loans. And yes, there are other ways to buy things, but you need money to put down. There's an ability to repay rule under Dodd-Frank. So what I posted on social media, which we're going to look at and expose here today, was that, and I continue to post this, is that supply is not the biggest constraint on housing affordability right now. And the internet lost its mind. Of course, everybody arguing with me is debating this from a political virtue signaling point, and none of them have something like this. Okay, look, we have a housing affordability matrix, an index that we use using the Fed's data, the St. Louis Fed's real-time API, giving us access to this information because we're looking at this from a straight mathematical problem. Keep your politics out because this doesn't involve politics. This is an actual model. And guess what? Nobody talking to me is going, well, Chris, we've got a model. Let's tell you what it says. Every single time. One dude even pointing me to the Furman Institute, okay? You pointing me to an institute which talks about the long-term impacts of supply is no different than my guy from the White House ignoring that his narrative is entirely based on long-term implications of inflation and tariffs and ignoring what it does in the near term right now. Yes, long-term, more supply changes prices, but causation versus correlation, kids. Let's look at the index here and let's be thoughtful without being political. Number one, mortgage payment burden continues to be strained. Why? Home prices are high and interest rates relative to where they were during this 14, 15 years of artificial interest rate deflation period are in fact almost double in some cases, even with today's current rate just above 6%. Again, this is the St. Louis Fed data. It is dated. It's a lagging indicator, sorry. Mortgage rate pressure is what we just talked about there. It is still the biggest impact here. And this is why I say supply is not the biggest determinant to affordability. 1 percentage point up or down can change up to 30-35% of buying power. That is a huge trigger up or down. Now, I am not advocating for lower rates. I think we are probably at the right point for mortgage rates right now, despite that many people don't like that narrative. And I don't think that cutting the Fed funds rate is going to meaningfully move the treasuries. The 10-year is back up today, I believe. I think we're a little over 4%. As a matter of fact, I'll check that right now on the show because I like to be statistically accurate because the trolls do come for me in the DMs. As much as I love you trolls, every once in a while I try to be right. I try to be correct. So let's look at CNBC. I'll go over to the bond market. I'll pull you on over to the screen here. 10-year treasury is back up 4.08%. So you will see a continual upward pressure on mortgage rates throughout the day. I think you're going to see mortgage rates settle just above 6% until such time as something meaningful changes. Getting back to the affordability index here. So what do we know based on what we just saw? We know that, number one, mortgage rates do impact this a whole hell of a lot more than anything else. Of course, the second piece, obvious piece to home affordability is if prices came down. Again, about 35 to 40% would get you to, I think, more affordable based on wages. And therein lies the third problem. Wages have not kept up meaningfully with the increased inflationary cost of homes. So keep in mind, over a period of like 4 or 5 years, homes went up about 45%. Your wages, my wages did not go up 45%. And yes, wages have crept up. He was not wrong about that in the past year, but there's also a big disconnect there, which I'm going to show you here in a minute on why wages are not exactly being represented fairly. And it's a new chart to me, so we're going to have to unpack it. So when I say that supply is not the biggest determinant, I look here. Okay? Our model clearly says that the biggest strain on affordability right now is the rate pressure in the mortgage locked out market, okay? And number two, the actual cost of the home. Freeing up those two vehicles, this would then be the third limit, and it is nowhere near close to a big as limit as everything else is in the market. Now, this is not to say that home affordability is good. I am not saying that. We are clearly saying that we are in a strained home affordability market with a very low affordability index score. There needs to be a solution to this problem. I am just saying that housing supply in and of itself will not solve this problem, okay? I cannot say that any more clearly than I am now, at least not near term. And anybody who points to places like the Furman Institute is disconnected to how the near-term and long-term implications of this change. And look no further than 2022 through 2026. Did anybody get a dramatic, hefty amount of supply? No, you didn't. Construction deliveries to the market are actually changing in a way that discounts this rule. And I can get into some of the analytics there. I'll probably do that on the actual podcast show as opposed to here. But suffice it to say that supply has not meaningfully changed in any of the markets. What happened, people rushed to some of these markets, mortgage rates and demand changed. But again, demand without affordability is not demand. Once demand got too high, people got discouraged. Prices got too high. They got discouraged. They left some of these regions. And as they left these regions, less buyers, which meant the same supply deliveries to the market were being put in place. And as a result of this, prices went down because buyers weren't buying. And that's the impact here. The affordability got to be the problem, not the supply deliveries in and out of the market. I challenge anybody here to show me one of the top 15 metros in the country, or the top 50, that are starting to see price declines that had a meaningful change in supply delivery that changed the metro market there. That, I guarantee you, was largely not the problem. I would say the one caveat here is probably Miami, which had a ton of luxury units being delivered to the market, which are now being a little bit, priced out. But that's a different conversation for a different day. So let's get back to the show here. I know we started off on a bit of a different foot. I'm going to pause here and I'm going to go to the comments on the Instagrams. I know you guys are seeing me a little visceral here. I apologize for that. No one with a 2.7% interest rate giving up their house so they can buy at 6%. That is correct and most likely true. White House spokesperson took a Dave Ramsey econ class. Oh, you're an OG listener when you reference my boy Dave Ramsey. You're dead homies, as they say, right? There's some posts I put out recently which show that he was fundamentally incorrect over and over again. His finance guys hate me, by the way, and I fully respect them. Shout out to you guys. I love you very much. Vic, what up? I wonder where the White House spokesperson learned economics from. What a madman. I don't know that this is a guy, by the way, who is supposed to be, I think he's head of like I can't remember what Hassett's actual role is. I'm gonna look this up so I don't misquote, but he's supposed to be somebody who meaningfully really understands and knows this number, and he doesn't. So, or he does, and he's trying to manipulate the zeitgeist because he knows near-term, long-term argument impacts. Let's check the status of the market, kids. Market status as of today, the market shows no clear trends. We are showing Dow Industrials, S&P, NASDAQ, Russell, and QQQ all meaningfully positive. But that being said, we're not seeing any mirror factors here. As we go through, remember to check on this here. This is going to tell us the status of the market, no matter which chart we ultimately jump to. So we are seeing no clear trend on a mixed day in the U.S. markets. Our synthetic volatility index, our risk models here tend to show us some stability. We're well above normal, entering into the calm range here of overall risk. So we are not seeing anything, despite the funky rhetoric on the social narrative, that shows us anything that's scaring us in the stock market perspective, which I think makes for an overall pretty uneventful day, other than the behavioral economics that go into me getting all sassy and feisty. So let's jump into liquidity score. The Fed policy is still restrictive, although I am seeing some improvement. Those who've been following the show for some time know this has crept up a little bit. The Fed balance sheet is still flush with cash, but the reverse repo and treasury accounts are running some of that off. So our net liquidity is still an incremental drain on average. We're not dumping money in, and I wouldn't expect them to do that anytime soon. If inflation looks like it's falling in line, jobs came down to 4.3 on unemployment, I think they're going to wind up saying our dual mandate seems to be in the places close enough to where we don't make any meaningful changes, and they'll continue to reiterate their data-dependent rhetoric. Oh, that's a lot. Yeah, and today was a GDP. We have a GDP print coming out here, which is going to be important. The FOMC minutes came out today. I will tell you a little bit about that here coming up shortly, and we have some GDP information coming out on Friday, which we will need to unpack on that show. So we'll have an light show on Friday. So the minutes that came out today, which I hope to cover with Saeed on the show, depending on when we're able to record, seem to suggest there are three meaningful camps in the rate cut scenario. There are those who favored a rate cut, obviously the Myrons of the world. There are those who favored keeping things where they are. And there are those who are very uncertain and almost suggested like rate hikes. So a whole lot there to unpack in a longer show when we have a little more time. And anybody, let's pause for some comments. Who's out there? What's going on? I think most of you guys are on Instagram today, watching me talk all the smacks. Have you guys seen the same ridiculous? Am I fired up for no reason? Because I feel like a lot of people should be pissed off about this, and maybe I'm just pissed off because I was grumpy. I slept great last night, though. Maybe it's just I'm a grumpy dude. Saeed on the stream, giving shout outs to the merch. Yeah. you gotta love when Saeed, my BFFFF, is literally in the show notes dropping stuff, reminding you where to get merch from stuff like this. I pretty much wear exclusively THS merch. If you heard anything on the last episode, 322 that came out, where the policymakers with the solutions, what is it they are paid to do right? This is actually a good question, a good statement, although I think Saeed is doing his own little THS pod virtue signaling here, but it's actually a funny thing to unpack a little bit. I know that I get fired up about this stuff, and I know that I can come on pretty strong because I will push people with commentary and rhetoric on places like social media platforms, X, Threads, LinkedIn. I do this from a place of love, and I know anyone's going, bullshit. No, it's not motivated. What I'm trying to say, and I'll be candid here, I don't have a solution to these problems. I really don't, and I don't think more brilliant people than me have a solution to these problems. As a matter of fact, I think the problem is that no one has a good, meaningful solution to these problems because we find ourselves in the same place where if anybody did, it would be popular rhetoric and we'd be all handling this situation. We're so busy fighting with one another, and the politics and virtue signaling included in that are so just focused on the differences that we're not coming up with meaningful collaborative solutions. And I'll use aliens as an example, right? Somebody is going, what the actual shit? Yeah, aliens. Okay, let me explain. In theory, if all the scientists in the world, not just the United States, but the world, got together and they all put their head together on the concept of aliens, we would have way more smart people in a room, assuming they were open, kimono, and transparent, right? Who are working collaboratively to find a solution. Do these exist? If they do exist, can we all reverse engineer that technology? Can we all get better together? But that is inherently not the way humans work. We are tribal. And because we are tribal, we want, it's mine. I need power. In order to have power, I need to have secrets. And unfortunately, this is the way the economy and the economic data works too, where everybody wants to control their narrative because they believe their power should help them effectuate their end goal, which may not be the altruistic end goal of us all having a better life and better society. It could be the advancement of what their perceived agendas are versus the advancement of the entire species. And therein lies this fundamental human disconnect, no matter what country you're from, no matter what political agenda you have, where we don't seem to fall in line with one another. And it's going to come to a head at some point in time where this stuff gets to a point where you have people, I don't know, like on social media, just out and out lying and laughing at themselves on national headlines. So, I mean, maybe this is just something that everybody's comfortable with. Maybe people bought that. Maybe somebody out there was like, hey man, that guy sounds like he knows what he's talking about. He seems authoritative. Let's check the sectors. I think it's important to get into some of this before we get into some of the AI rhetoric, which we've already got a little bit there. Housing sector seems to be a little bit mixed. Nobody really big or up and down on the day. This is going to be largely in response to rate-sensitive demand. As you're seeing here, rates have somewhat stabilized, the 10-year going up, so this does not surprise me in any way, shape, or form. The banks continue to be a shining star. If you remember from the show, in previous conversations, we said look for the banks, look for energy, look for industrials, and depending on where consumer sentiment comes out here, I think it's on Friday, I think we should be somewhat positive on where that's going to go. Necessities are going to continue to be where consumers spend. And there is some trouble in paradise, which could affect places like Home Depot, and we'll look at that sector here shortly. So none of this surprises me. There is continual buzz around credit conditions in the commercial real estate. We do define that as a separate sector, so we'll get into that here next. This is your CRE and your real estate investment trusts. All of them are getting kicked in the ding-ding today, and I think that's because you're seeing more and more news come out about how troubled these sectors are as far as their payments go. I think, again, you see office space with a heavy hit here. You're seeing a lot of the retail malls being hit here. And there are some multifamily properties, particularly those in the Sun Belt regions of the United States, which are getting impacted. A lot of high-end luxury deliveries to the market where those rents that they try to achieve on a takeout loan are not achieving what they need to, and therein lies a bigger problem. So how they handle that from a cash flow perspective remains to be seen, but apparently banks are pushing back, and there's some narratives that are on the social sphere about how there's trouble in paradise here yet again. I think you're going to see this in the mainstream media here not too long from now as a continual conversation once again. Mega caps, all up incrementally positive on the day. Apple, Microsoft, NVIDIA, Amazon, Alphabet, of course, they are the benefactors of some of this whole Claude AI or Open Claude, depending on where you're at in the life cycle of that company's growth. And I want to spend a little bit of time towards the end of the show talking about some of the fears I have around AI. As you know, I kind of nerd out. A lot of what we're doing here involves some AI. As a matter of fact, I'm going to show you some AI stuff here in a little bit from the AIX and social media behavioral economics analytics that we look at. But I have some deep-seated fears, and I want to show you all where I think we are in the zeitgeist of this evolution, and I think there's some lies going on there too. So we're going to unpack a little bit of the lies that's happening there, because as you know from previous shows we've done, that I feel strongly about the whole quantum computing element and some of the things that have happened there. We've covered it on previous shows, really esoteric kind of science that we don't fully understand yet. But that being said, there is a crossover to the AI world and some of the things that I think we can deduce logically from things we know as facts today. So stay tuned to the very tail end of the show for that. Let's go to the consumer sentiment. I think this is going to continue to be a shining star over the period of time. I think the consumers are going to get hit a little bit, but I think Walmart, Target, Costco, Home Depot, Dollar General are going to do well. I do worry a little bit about Home Depot in that the consumer seems to be running out of cash, so they're going to continue to tap into their homes. And what could go wrong? What's going to happen? Consumer runs out of cash. Consumer taps into home equity lines of credit. All the mortgage bankers go, great, I'll give it a home equity line of credits. Oh, great, it's a home equity line of credit on a property that's got a ton of equity in it. What we'll do, we'll get an AVM and automated valuation model appraisal for these properties. We're not going to have somebody drive by, and we'll get some bit of cash in 3, 4, or 5 days, as opposed to having a physical appraisal go out there and taking weeks to underwrite these things. This, to me, as a former chief credit officer for decades, this to me seems like a bad recipe and a Molotov cocktail for problems that are going to probably manifest later on, particularly if home values do decline, as they should. But again, I don't know what the catalyst for that would be. So if you guys are out there smarter than me and you know what the catalyst would be, I would love to hear your thoughts and or sentiment around it. Checking the comments here. I want to go back. Let's see what we got here. I've been paying attention, kids. I'm not ignoring you, Samson. Let's see what else we got here. From a legal perspective, legal question? I'm an attorney. Why not? From a legal perspective, if the Supreme Court reverses the tariffs, how does that affect refunds? Okay. Well, they haven't really declared additional tax refunds clearly, is my understanding, as far as additional money going out. So therein lies a question. What Samson's referring to here is there is a continual narrative that the Supreme Court is likely to strike down some of the tariffs that the White House put in place as unconstitutional. Interesting argument. I don't know constitutionality arguments around tariffs in that particular executive legislative branch tension as well as I probably should as an attorney. That wasn't my subject matter expertise. But what I will tell you is that I thought about this when I heard the headlines come up, and I want to point out what I think could be an interesting narrative. And we should probably go side view for a more serious, dark tone. What do you say, Samson? Let's go for it. Okay, so let's think this through. If you're the White House, and I'm not saying this is true, but I'm saying it could be true, and you put tariffs into place and you weaponize these things, and you knew there could be a constitutionality challenge, and you knew that it likely would wind up with the Supreme Court because people are going to challenge all the time. Okay, cool. If they knock that down, you can say, I tried to help the economy by doing something very unique, X, Y, and Z, and they prevented me from doing it. So this is a politically motivated problem that we're in. So if we do go into a recessionary economy, which again remains to be seen, or if the economy continues to worsen, you could suggest that you, as the executive branch, decided to do something meaningful about it, mind you, and that you were strucken down by political agendas and ties that happen in the place. So there's a built-in narrative for failure there if it were to come to that. Now, I, again, don't know the laws well enough here. I'm just thinking through how this could evolve, if that makes sense. But certainly, I think that there's some fears there of that rhetoric happening. It would also, frankly, from just a power standpoint, really emasculate the country as it deals with other countries. The last thing you want to do is emasculate any leader, whether you believe or agree with this person or not, in front of a national stage. So there is a high risk, high gambit poker game playing out here. And I don't know which devil is better in this scenario, if the tariffs are not struck down or if they're not struck down. So again, remains to be seen. We'll have to all watch that play out a little bit meaningfully over time. And I hope, Samson, that answers the question the best that I can. I'm not a subject matter expert on that topic, but certainly there is an evolving landscape of information there. Let's get back to a couple more sectors before we jump into the XAI stuff here. I think is important. There's some interesting narratives here. Let's go to the industrials for a little bit. Caterpillar, Deere, General Electric, Union Pacific, 3M, all kind of mixed day. And again, we're still in a mixed day period here for those of you who remember from the top of the show. Energy, we continue to think will be a shining star. I am going to get into AI a little bit, and I'm going to explain how I think this is so underrated. The energy sector is so underrated. There's also the geopolitical aspect. Right now, there's some rhetoric about Iran and talks breaking down. and some of the things that are happening there that could result in some airstrikes, which I think is a very scary proposition to all of us Americans, and that will drive, from a geopolitical and financial level, numbers up. As an Iranian myself, I can tell you that it breaks my heart to see what's happening over there, and I've tried to stay largely silent about it because I have concerns the U.S. will not engage, and if so, I don't want to push a populace to think that the people here support them in a way that's going to change their lives if the U.S. is not willing to enter and do that, if that makes sense. But certainly all these tragedies that are happening worldwide right now, you can't forget about Israel and Palestine. You can't forget about the Ukraine and Russia. You can't forget about, all these things that are happening. And it's so crazy to me that we hyper localize on one thing in the media, and then it like vanishes, but the occurrences of those things have not been resolved. And the virtue signaling online, the arguments, the animus, the anger, it's all still there underneath the media substrate, but the media just doesn't talk about it anymore because they don't get the headlines, because people are burnt out. It's something that I will never truly understand. So I try to stay very silent on my opinions on these topics, because I like to see action from our country before we do or say anything. And it's so rare that we see overt action anymore from our country, because everything happens in this murky black and white area, or gray area, not the black and white, where you and I and everybody else don't really know truthfully what is happening, other than the things we see from these sources that are really, really hard to validate with all the things going around us. Let's look at defensive and yield positions. This is where we know the money goes to preserve capital. And right now we're seeing this risk off perspective in places like Bitcoin. Syed, if you're out there, I know how happy that makes you to see that Bitcoin continues to struggle, because he does have what we define as a technical term of wet paper towel hands. And you know what? At this point in time, those have actually been very lucrative wet paper towel hands. So, but I would say, as they say in the streets, prayers up, dead homies. We're seeing some problems here in the Bitcoin market still. Michael Saylor, wherever you're at, brother. $65,981, a far cry from the 126 that Bitcoin was at. You could call this a crypto winter. You can call it a lot of things. The only problem is right now with the push, the electrical grid already was pressured with Bitcoin and cryptocurrency miners. Layer in the semis. Layer in the AI infrastructural needs. And now, outside of cryptocurrency, you've got huge burdens on the electrical grid and power needs that are creeping up, so much so that what we saw in Pennsylvania, you saw it go massively skyrocket up. They hit their legal in place thresholds to limit that, at least for the consumer. We got a problem coming with that, and that's why we're going to cover the tail end of the show. This now costs $20,000 more to mine a coin of Bitcoin than the actual coin costs. It's about $85,000 last I checked. I probably should check again. If that's how much it costs you, but you only get this much value, you are betting on that value getting back above the cost for you to mine. And this is where I look at Michael Saylor and I say, hey, dog, hey, are you really this confident? Or are you just trying to, pimp some coin? And if Syed were here, he'd say he's trying to pimp some coin. I mean, obviously look, I'm trying to pimp the show. I put the brand right there, okay? Michael Saylor's shirt has a Bitcoin icon on it. We know what's up, okay? We're not hiding it. We know. All right, let's get into XAI, social narrative rhetoric. For those of you who are new to the show, this is an important part of the show. This tells us what's going on in the social media. And you're like, well, what? How does this happen? I'll explain it to you. I'll explain it to you as eloquently as I can, coming from a moron who vibe coded it himself. This is going to tell you exactly what the narrative is on social media by going to X, going to Instagram, pulling all that information in, and giving us, call it 8 to 10-ish of the most trending topics in the zeitgeist right now and how they impact you. They're going to give us the headline and what it actually is saying. They're going to tell us what the engagement rate is, who it's going to impact, what the risk level is. It's going to give us some AI insight. Oh, Claude, you dirty boy, telling me how to move in the markets. And then it's going to give you a controversy score. How controversial is this take? Is it contested? Is it divided? Or is the consensus amongst the people that this should be, in fact, what it is? These numbers are related. I'm just trying to relate to you what the controversy score is. A 3 of 10 means it's highly contested. A 10 of 10 means there's pretty much consensus around the overall topic. And that's what these charts do. Now let's go over this one by one, because even though you have a social media algorithm just like me, The problem for you, me, everybody else is the social media algorithm, which is proprietary. They don't tell us what it does. Naughty, naughty social media. I'll see how you argue that on Capitol Hill. This is going to tell you what's going on without this bias there. So the algorithm pumping stuff to your confirmation bias is irrelevant to this, because I'm telling you to look at certain pages, I'm telling you to pull information in, but it's going to go out there and do it on its own because it's smarter than you and me. And again, we'll cover that whole problem later on. Turkish lira currency collapses. The Turkish lira hits an all-time low against the US dollar, now down 97% since 2010. Currency crisis continues as emerging market concerns mount. Say, what now? Okay, I'll explain it to you in AI speak. While Turkish lira collapse dominates the headlines, look for oversold opportunities in Turkish ADRs and consider emerging market currency hedged ETFs. Essentially saying that Turkey is an emerging market and that these will be down on the news of this today. And as a result of this, anything with exposure to emerging markets will be down. But long term, they will find a way to stabilize their currency and this will return. If it lost 97% of its value, old school investors would tell you it really only has one place to go, and that's up, because it really ain't going to go down a whole lot more unless you expect an entire country to collapse. So what this is telling you is you could probably be bearish on the overall sentiment of it, but bullish on the idea that there's some recovery built in here. And that is how this bad boy works. If you love it or hate it, that's all good. I respect it, but that is what it is. Let's go to the next one here. Bond yield expectations rising. We saw a little bit of that with a 10-year look earlier here. 60% of fund managers expect bond yields to rise long term, highest since February of 2022. Ugly 20-year Treasury auction shows lowest foreign demand since 2021. Less countries wanting to buy our long-term debt is what that is saying. And they're saying that's a worry. And most bond traders are telling you that long-term you're going to see these things rise. AI's take on this, of course, rising yield expectations create bond selling pressure, but contrarian play could emerge if inflation data surprises to downside in coming weeks. Effectively saying that the long end of the curve, the 10-year, continues to be resilient and rise back up, even though we saw it dip a little bit here. And the only thing that seems to be knocking it down is seeing that inflation is in line. If inflation continues to be in line over the course of the next couple of weeks, you can expect to see a little bit of relief in the Treasury and or bond market and vis-a-vis this, the 30-year mortgage market. However, if you don't see that, and I'm not sure that we will, frankly, you could see prolonged period of higher bond yields, meaning that higher mortgage rates would likely be on the horizon. I'm not talking meaningfully high. I'm just talking a slow creep up over time, at least based on what we see here, unless something meaningful were to happen. Now, you might be saying, okay, Chris, well, what if they cut rates and Fed funds and all that stuff? I don't think you're going to see the same connect that you saw. You'll see some, they'll announce a rate cut or it'll lead up to a rate cut, and the probabilities will show that there's a rate cut coming, and Chicago Mercantile Exchange and Bloomberg's World Interest Rate Probability. You'll get some near-term interest rate relief, but long-term, I think there's a bit of a disconnect here where you're going to have the treasuries go up higher over time, and I don't think that the FOMC's Fed funds rate is going to cut, meaning a whole lot of meaningful benefit to you, me, and everybody else in the form of bond pressure relief. What I do think you're going to see is you're going to see as a FOMC does get rate cuts, if they do, is see your interest rate on your high yield savings account go down while mortgage rates stay elevated, meaning that the bank sector, which we talked about earlier, and I said we were a believer in, is going to continue to have wider net interest margin, which is how they drive their profitability. I've been talking a lot. Let's pause for comments. Let's see who's out there. Yo, Instagram, I see you out there. I love you too, Matthew. Pumpkin, that's so sweet of you. Who we got on the other platforms? So many platforms, so little time. Legit, thanks. Yeah, of course. Got you, Samson. No problem, brother. All right, let's get into some more of the XAI, and then I'm going to wrap up here with this AI conversation that I have foreshadowed. I have teased. I've given you a little bit of the sexy on. Hopefully, I haven't oversold it because it is good in my mind, but I am a little insane. Okay, going on to the next factor. You're going to like this one, kids. This is housing market normalization. All cash home buyers dropped to 29% in December, the lowest number since 2020. Where the hell are y'all getting cash from? I mean, crazy. All right, Phoenix inventory up 50% year over year, signaling market cooling from 2020 to 2022 extremes. Okay. Now that is an example of how price differences and a buyer unwilling to participate can move the market. Do you think they provided 50% more homes to the market? Or do you think that's how many homes are in the market now because people were unwilling to buy? A reminder, you can buy a new home for less on average than you can buy an existing home in this country today because of the concession that builders are making. The problem with the supply and demand argument is that builders control the supply, and builders are capitalist. They learned during the great financial crisis that they don't want to overbuild and not have properties move because then all their money is tied up in the value of the real estate, a tangible asset, and not in cash. And their whole business is making money off selling properties. That's why they build them. So if people aren't willing to buy and they have to take an economic bath on them, they just slow down production until they can have stabilized pricing. So unless you incentivize the builders to build regardless of the price of the home or their profit margins, you have a fundamental capitalistic math problem, just like your boy in the White House, whose near-term, long-term disconnect was palpable. Yes, long-term and supply and all those things will happen, but near-term, how do you motivate them to do it? A question that I don't have an answer to, but unfortunately, social media seems to think it's smarter than everybody. AI's inside here, housing normalization could benefit first-time buyers and mortgage lenders while pressuring home construction stocks in overheated markets like Phoenix. Yeah. AI, you're not wrong, Claude. You're not wrong. Wealth inequality is also a topic we've covered a lot on the show. Consumer sentiment among non-stockholders at 8-year lows, while larger stockholders reach highs. Of course, because people who don't own stock are pissed out because they missed it and they think that the market's overvalued. People who own stock are like, nah, let it ride, bro. It's great. 50,000 Dow. It's amazing. So there's that. AI and defense industry tensions continue to rise. XAI's out there, Anthropic clashing with the Pentagon over AI use, while Microsoft warns about Chinese government subsidies, AI adoption affecting entry-level jobs. And of course, there's some commodity stuff out there, but we're going to pause here because we're going to have an AI conversation. I could go into some stock charts if you guys want to see something. You guys tell me if there's anybody you want to take a look at, we can do that. And I can also run the forecast model, which I haven't ran in a bit of time here, to give you an idea of what that looks like. Let's take a trip down forecast model lane here. Let's go to NVIDIA, NVDA. You guys know them pretty well. I'll generate that and we'll head over to the forecast. This is what our outcome forecast model looks like. For those of you who haven't seen it in a while, I've been beta testing this a lot in the back. Anytime something comes up in our XAI stream, and we look at the social behavioral economic stuff that we just looked at, it's going to show trending here as a trending topic. There are no stocks today that were really, it was more industry sector specific conversations, so nothing that really directly affected this. But you're going to see this model more and more over time once we see more transactional activity in stocks that are making the headlines. We're not seeing that today. Again, we're in a very calm trading day, and there's nobody who's really an outlier. Most of the rhetoric is around this comment from the White House, and of course, there is the Fed minutes, which came out, and none of that is really affecting stock. But we are still working on the outcome forecast model. It is still an important model for what we do. It's just not something that we're going to spend a tremendous amount of time on today. Let's go over to the comments. And I'll take a bit of a break because I'm talking a whole lot. I know how you guys hate hearing me talk. Let's see what we got on the Instagrams. What up, Instagram? We've seen a good, healthy balance. Now, no one with a 2.7% interest rate. Oh, yeah, I read that earlier. Gosh, there's a lot of comments to catch up on. Hey, bro. What up, Maridad? How you doing, brother? Sebas, he discreetly says it's in one of his shows, or at least what am I missing here? When will you cover the reason for leaving the bank? Yeah, okay. I'm actually going to have some lunch with some friends from the bank in about an hour or so. So I will cover that when I can. And I'm going to do this on a live, and I'm not going to tell anybody later on in the show notes that I did this on the live. So if you're listening and you want to know what happened to the bank, I'll tell you right now. Well, I'm going to tell you when I'm going to tell you in the future. How about that? I'm going to tell you, I'm going to have a full breakdown of what happened and why I left and the context. The bank is in the process of being sold to another bank named Sunflower. That is public knowledge. We raised private equity, $228 million of private equity. And in doing so, there's a whole narrative that led up to that and after that, which led to my decision to leave the institution. I am wrapped up in one of a couple of lawsuits in which they're claiming that my departure was nefarious or had some weird thing there. So I've been a bit hesitant or cautious to talk about it. Not because there's anything nefarious. It's not. It's actually a pretty vanilla, boring story outside of what you probably surmise. But I do think that the conversation is a valuable one for the listener of the show because it tells you that not only does someone like me call this stuff out on this platform where it's visible, but I do it in my personal life because I care about the humanity. I don't care about the politics. I don't care about, people fleecing and lining pockets. I care about doing the right thing for the human. And if nothing else, I hope that my legacy with the coworkers that I left and departed was one that I truly cared about them and still do. A lot of them still talk to me to this day. I still keep in contact with them. I don't care whether they were a teller at the branch or they worked with me on the executive team. I love and care about all of them. They were my family for almost two decades. And it means a whole hell of a lot to me that they are in a good place, some of which have been laid off and are effectively gone as of 4/1 and helping to find them jobs have been a near-term value add that at least I'm hoping to add to them. So I promise you there'll be more coming on that. As much as I wanted to talk about it earlier, I can't do it because of some of the things that counsel and other people are telling me not to do, and because I don't want to impact anything that's happening with their current transaction right now, because there are still people there that are human that have jobs that I care about. So the last thing I want to do is go on a show, say my truth, and then have people be affected, not only just personally in the work environment, but psychologically. The last thing you want to do is have me come out and say something that could cause you to have hesitation around somebody else. You know what I mean? So you don't want to cause people unnecessary emotional stress during an already stressful and tenuous time for them, because they're transitioning. They're being sold from one company to another company, and people are looking for jobs. I'm not piling on there. All right, so let's spend some time on AI. Thank you, Rosie. I appreciate that. That means a lot to me. Honestly, having more time with my son and my wife has been that good thing. Having the ability to talk to you, to do this kind of stuff on a live has been that good thing. So I feel very blessed every single day to be able to do this. I don't care how many people, how many views we get. I care about being able to speak freely, which for a long period of time, I was not authentically able to do. So let's talk about AI a little bit. I'm going to pull this up actually, I think in a Word document, because I want to do this from more of a visually appealing way. So let me do this here, Word. Believe it or not, I actually do use Word still. Everybody else seems to be using notes in AI these days, which I think is a little weird. I'm going to pull this up in a blank document because I want to show you guys a little bit about what I'm looking at here. All right, so I pulled this down with the help of AI itself, which is wildly ironic, I admit. And I wanted to point out where we are in the AI scope of the world. And I'm going to do like a longer post on this at some point in time. But for right now, I want you guys to see this. And I think this is probably a bit small, so I'll make this gigantic for you guys. There we go. All right. So in the AI world right now, there are several different paradigms, some of which we've already crossed, that I think are important. A&I, narrow AI, task AI, systems that do specific things well, speech recognition, recommendations, vision models, most classic MLs, right? We already have this. We've had it for a long time. I wouldn't really call it AI as much as I would call it systems at this point in time, but certainly we're there. Then, of course, we rolled out LLMs, learning language models, foundational models, general purpose interfaces, broad language and reasoning capability, but not inherently autonomous or grounded. This is where most ChatGPT class models started. But I don't think that's where we're at today, because if you've seen some Claude and some of the stuff that we're seeing here, we're seeing some very big changes. Tool using AI, I think this is where we're at today, personally, at least in some models. Vibe coding, whenever you're speaking to AI colloquially, and you can build something like we built here with this show, that is all done by vibe code. You're now using AI. AI is going out and using tools to help you facilitate. And if you've ever seen Claude or ChatGPT give you kind of the light gray context of what it's actually doing before it gives you an answer, it's telling the tools and the things that it's looking at while it's doing it. And now we've switched to agentic AI in this Claude bot, open Claude, this whole model that we're looking at currently. And to me, this is scary. Not scary because of what we're doing. I actually am very fascinated by it. Once I can get my arms around it a little bit more, I'm probably going to roll one out for a real-time AI bot that'll be on the show with us as a willing and able participant, something that I can message and engage with as well. And for me, that facilitates kind of like having an assistant, but also having somebody dedicated 24 hours a day, 7 days a week, 365. And we'll talk about how that rolls out. But here's the scary part. Here's the part that I think we're disconnected with as a society. One man coded this in just a few weeks on his own and distributed it to the world. Hundreds of thousands of people now are building their own agent AIs, not necessarily smarter, but more self-directed, plans, executes, monitors, retries, and coordinates tools over multiple steps. Important, agentic AI is not general AI. We'll get to that. Now, we already know that people like NASA and Google have joint enterprises for things like quantum computing. And we know that a lot of these tech companies are looking into nuclear power because there's a power shortage. I believe the limitations here at this particular juncture in time is not our ability to get to AGI. It's the ability to get power to push AGI. And here's an interesting stage, which is often missing: the domain generalities. Generalist AI assistants, systems that are robust across many domains and environments, not just language tasks, but better memory, longer horizon planning, fewer hallucinations, and more reliable execution. And I think we're getting that right now, where agentic AI has evolved so unbelievably fast that these AI agents can do multiple things. So for example, you can teach your Claude bot agent multiple different skills, and those multiple different skills can be used in multiple different ways. You just have to prompt it to address each skill. And that's a very narrow window to pivot to where you're truly at domain generalist, where you can just say, hey, go do X, go do Y, go do Z, and it's going to be able to figure out those things with the skills that it has and the ability to learn that you've given it. So there's a whole lot there, but I think we're already here. And if we are there as a society, if you, me, and everybody else is buying a Mac Mini and doing this shit for $1,000, then I guarantee you Google is far advanced. I guarantee you the government has some independent contractors that are far more advanced in this. And what scares me is that we've seen some contrarians come out and say stuff like they're afraid of what's going to happen next. And it is that because, and here's the question, have we already really truly reached AGI, but giving that public knowledge at this particular time is potentially a national security threat, right? If we have AGI, the government's going to want to have control over that before it's rolled out to everybody else. But if one man can roll out agentic AGI, which is now already run into domain generalists, at least in some way, shape, or form, then it's hard for me to believe that somebody hasn't already figured this out, with the only limitation being power supply. And there's only a few people in the world that can manage to get that kind of power supply, and one of which is the government. A person, no, but a government, yes. And those people who have the infrastructure and the power to supply that kind of power to something like this could probably pull that off to get us to AGI. Roughly human level or better competence across multiple economically valuable tasks with strong transfer language and adaptability, not just passing tests, but operating the world effectively. You look this up, some people will say it'll happen late 2025, early 2026. Some people will say it'll happen 2030s, early 2030s. I believe we are already on the cusp of this, and it's already happening, if not behind closed doors today. So, I mean, given everything we're seeing from the public that you and I can do right now, it's hard for me to believe that this isn't something that the government has access to and can control, but certainly doesn't want everybody to lose their friggin' mind if this is out there. We're already seeing people lose their mind with AGI. Can you imagine? With agentic AI, can you imagine if people knew or thought we were here already? Then often missing stage is ASI. It's recursive improvement dynamics, not always listed as a stage, but common concepts, systems that can significantly improve AI R&D. So the ability of AGI to get to the next stage, super intelligence, the upper pyramid, top of the pyramid here, is really that in-between stage is often missing in most people's descriptions. And I think it's important. If AGI is sufficient enough to improve itself, then you're going to know very quickly, and very, very quickly, frankly, I might add, because it's going to move faster than you or me. It's a silicon-based life form at this point in time, that we've gotten to super intelligence, far beyond human capabilities across the board, science, strategy, persuasion, engineering, etc. And that's where the wheels come off this whole thing. And this is not some dystopian future. This is not some crazy future forecast. This is real, man. We are already in a point where I think we're already at AGI personally, my personal belief. There's lots of people who are going to disagree with me here. And even if we were, I wouldn't know about it anyway. So let me live in my fantasy land. And we're not, after that, the wheels come off and we're in a different world. So that's my fear. That's what keeps me up at night. I think a lot about this because unfortunately, this does displace a lot of us as workers. Yes, it will create jobs long-term. But again, like we talked about the entire show, near-term, long-term, not always the same thing. I did have some stuff to get into with jobs but you know what? I'll save some of that for another show, another day. We have a Friday show coming up and maybe I'll cover it there. Thank you for everybody who tuned in. There's a lot of you on the platforms who stayed with us for the whole entire show. I don't know what our retention rate is on this one, but it's going to be high. So I sincerely appreciate you guys tuning in. The entire show will be posted up on Instagram for 24 hours. That's been kind of our reoccurring theme. No, it's all good. I appreciate you tuning in. I know some of you guys got here late. Unplug it. I'm a white-collar mid-level analyst. Yeah, well, you and me are both in trouble then, Rosie. I got to tell you, it's not a good future. But I think what we can do is there'll be places for people who understand the business from an analyst perspective that'll be checkers of these things. So again, I wouldn't think the world's coming undone from that perspective. I would think the global conflict world is going to change dynamically when these things are in place. But again, uncharted territory. So who really knows? I'm going to look at the comments one last time. It's Nick's Tech Guy. Yo, what up, Nick's Tech Guy? Welcome, bro. I like your guys' stuff too, man. I hope YouTube reached back out to you guys. We reached out to them. I do think that band you guys had may have been something that was independent of us, but we can talk about that at a later time. I got to run to some meetings later today, but certainly if you want to call me later in the afternoon, we can talk. Let me check on the Restream stuff here, see if anybody out there on Restream has any comments. Legit, Samson. Okay, we're good. All right, everybody. I got to run to a lunch with some former colleagues who I very, very much love and miss. I can't wait to catch up with them. I will share that story at some point in the future. Thank you again for everybody tuning in. We are going to record a show this week. If you want to hear anything, you can email us at media@higherstandardpodcast.com. I appreciate you. Hugs and kisses. As Said would say if you were here. Okay, bye.